8.3 Fairness and the Big Trade-off. In 8.2, we examine the incidence and efficiency of different types of taxes. But when political leaders debate tax issues, it is fairness, not just incidence and efficiency, that gets the most attention. Economists have proposed two conflicting principles of fairness to apply to a tax system: the benefit principle, the ability to pay principle. The benefit principle. The benefits received principle, which is a theory of income tax fairness that says people should pay taxes based on the benefits they receive from the government. If taxes are based on the benefits principle, the people who enjoy the largest benefits pay the most for them. For example, taxpayers who own or drive cars should pay more taxes that go towards road maintenance than taxpayers who do not own or use cars. However, it is difficult to separate what goods and services are for the good and maintenance of the entire nation and not just an individual. A tax provision that says a donor who receives a tangible benefit, which is measurable like cash flow or cash income or cash reduction, from making a charitable contribution must subtract the value of that benefit from the amount claimed as an income tax deduction. So, for example, if Jane bought $500 ticket to a non-profit fundraising gala and received a dinner worth $100, she could only claim $400 as a tax deduction. This rule, in theory, might help curb attempts to avoid paying taxes by donating money to tax deduction purposes. As a tax regulation, the benefits received rule discourages double counting charitable donations. The second is the ability to pay principle. The ability to pay principle is a proposition that people should pay taxes according to how easily they can bear the burden. A rich person can more easily bear the burden of providing public goods than a poor person can, so the rich should pay higher taxes than the poor. The US tax system is a progressive or ability to pay system, meaning that those who make more money tend to pay taxes at a higher rate, and those who make less money tend to pay taxes at a lower rate or even receive taxpayer funded benefits while paying no taxes at all. The ability to pay principle involves comparing people along two dimensions, horizontally and vertically. Horizontal equity. If taxes are based on ability to pay, taxpayers with the same ability to pay should pay the same taxes, a situation called horizontal equity. While horizontal equity is easy to agree with in principle, it is difficult to implement in practice. If two people are identical in every respect, horizontal equity is easy to apply. But how do we compare people who are similar but not identical? The greatest difficulty arises in working out differences in ability to pay that arise from the state of person's health and from a person's family responsibilities. The US income tax has many special deductions and other rules that aim to achieve horizontal equity. Vertical equity. If horizontal comparisons are difficult, vertical comparisons are impossible. Vertical equity is a requirement that taxpayers with a greater ability to pay bear a greater share of the taxes. This proposition easily translates into the requirement that people with higher income should pay higher taxes, but it provides no help in determining how steeply taxes should increase as income increases. Should taxes be proportional to income? Should they be regressive? Should they be progressive? All of these arrangements have higher income people paying higher taxes, so they all satisfy the basic idea of vertical equity. But most people have strong views that include the extent to which the rich should pay more. US tax code uses progressive income taxes, average tax rates that increase with income. Progressive taxes are justified as fair on the basis of the principle of vertical equity, but their use to achieve vertical equity produces the problem of the attainment of horizontal equity. The problems show up most clearly in the US tax code in its treatment of single people and married couples. The marriage tax problem. Should a married couple or two people living together be treated as two individual taxpayers or as a single taxpayer? Until some changes were introduced in 2003, the US tax code treated a married couple as a single taxpayer. This arrangement means that when a man and a woman get married, they stop paying income tax as two individuals and instead pay as one individual. The marriage penalty occurs when married taxpayers face a higher tax liability due to their marital status rather than would have by remaining single and filing individual tax returns. Married taxpayers pool their incomes when they file taxes jointly. The marriage penalty is the difference between the total taxes applied to two similarly situated unmarried individuals and the taxes applied to the married couple because the couple's jointly filed income is taxed at a higher marginal rate than unmarried taxpayers for the same level of income. Marriage penalties are the greatest where there are two wage earners that earn roughly equal incomes. Example: think about AI and Judy, two struggling young journalists, each of whom earn $20,000 a year and who get married. As single people, they paid no tax. Married, their income is $40,000, so they pay $2,000 a year in tax. That is 10% of $20,000. Their marriage tax is $2,000 a year. We could make a simple change to the tax law to overcome this problem for AI and Judy by considering them as two married couples as two single persons. That is what is done in most countries and what some economists say should be done in the United States. This small change in tax law will make AI and Judy pay no tax after their marriage just as before. Let's see another scenario. Frank is a painter whose work just doesn't sell. He has no income. Denies is a successful artist whose work is in steady demand and earns her $40,000 a year. As single artist, Frank pays no tax and Denies pays $2,000 a year, that is 10% of $20,000. If they marry under the arrangements that taxes a married couple as a single taxpayer, they still pay $2,000 in tax. Now compare Frank and Denies with Aya and Judy. If we tax married couples as a single taxpayer, both couples earn $40,000 a year and both pay income tax of $2,000 a year. But if we tax married couples as single persons, Frank and Denies pay $2,000 a year and Aya and Judy pay nothing. So which is fair? Horizontal equity requires Frank and Denies to be treated like Aya and Judy, taxing couples as a single taxpayer rather than taxing couples as single people achieves this outcome. But if it taxes marriage, which seems unfair. The big trade-off. The taxes that generates the greatest deadweight loss are those on the income from capital. But most capital is owned by a relatively small number of people who have the greatest ability to pay taxes. We want a tax system that is efficient in the sense that it raises the revenue that the government needs to provide public goods and services, but we want a tax system that shares the burden of providing these goods and services fairly. Our tax system is an evolving compromise that juggles these two goals. Chapter Review. The two principles of fairness of taxes, the benefit principle and the ability to principle, do not deliver universally accepted standards of fairness, and vertical equity and horizontal equity can come into conflict.